Nina Trentman with Bloomberg joins us with more on that. Nina, great to have you with us today. Good to talk to you again.
Yeah, thanks for having me. Thank you.
Thank you. All right, so kind of connect the dots here, if you can, for those that don't follow this closely, as to the potential impacts that banks might see if we do actually, have the default coming up in the next few weeks.
Yeah, I think there will be wide-ranging implications, not just for banks, but for financial markets and for credit markets overall. Of course, this is happening at a time when there's already a lot of stress in the financial system. As you pointed out, we saw Silicon Valley Bank, Signature Bank, and other banks collapse earlier this year, and we saw the takeover of First Republic through JP Morgan in recent weeks. We saw the Fed announcing another 25 basis points interest hike at its latest meeting, and now we're facing this potential X date that might be coming up around June 1. We've seen Janet Yellen warn about it consecutively and pointing out that there would be significant impacts, not just for financial markets, but also for just U.S. taxpayers that would see the implications of a potential default. I think one problem for not just for banks, but also for companies in general and also for market participants in general is this question as to, well, is it actually going to be June 1st or is that just going to be one of the potential dates? Because we do see different commentary around whether that would actually be the date off or whether there's going to be any measures that the Treasury can continue to cover this period. We know that there will be more tax receipts coming in from corporates and individuals in the middle of June. So that could give the Treasury a bit of a lifeline. But at the same time, we've also seen those stern warnings from Mrs. Yellen and others saying that there needs to be a deal and there needs to be some sort of resolution, either by pushing out the debt limit deadline or by agreeing on raising the debt ceiling, which the parties are currently discussing.
Right, and I think the question becomes then, how much does the uncertainty impact all of those sectors right now? Because as I mentioned at the top, I think even with this back and forth, there's still a belief that something will get done, that both sides realize they can't allow the potential impact on the credit rating to really get hit here. But there's still, I think, a concern of what is going on right now and potentially the shock waves that may be starting to hit at the moment.
Yeah, of course, we have seen in recent weeks Treasury markets adjusting and basically going higher for the beginning of June and throughout the summer, which basically indicates that investors to some degree are pricing in higher risks around Treasury bills that are coming due during that time. We've also seen notes from ratings firms. Moody's Investor Service recently put out a note saying that basically in past debt ceiling standoffs, there's only been sort of a pricing in of the potential risks 2 weeks before an expected date. So basically that's right now, that is this week and next week. So, and then the final week of May. So I do expect, and we do expect markets to start looking at this risk more seriously, and also for companies that want to come to the credit markets, that want to come to the bond markets, to take that into consideration if they have refinancing needs in the coming weeks or months. The investment grade bond markets, for example, have been pretty active in recent weeks. We saw 12 companies come to market yesterday. We are seeing Pfizer in the market today, potentially with a jumbo deal to fund an acquisition. So some of that will, of course, also be influenced by how the progress is made in Washington, or if it's not made, because companies are aware that this is a potential risk of them being able to tap the credit markets at the right price. And we might see companies standing off from issuing new debt later this month if there's no resolution, either that is being made, or there's no indication of a deal being able to be reached. One thing that is interesting, of course, is that companies are also, and analysts and bankers are reverting back to sort of previous standoffs, going back to 2011 and also to other standoffs in between. And we do, of course, see that sort of the closer that the lawmakers get to the potential default date, that there's an increase in pricing for market participants. So even if there is an agreement, the fact that this hasn't been resolved until now is already causing additional costs for companies and for taxpayers who basically have to, in some way or form, pay back the U.S. debt with their tax payments. So yeah, that's certainly something that's currently going on.
But in the short term, the piece to this to keep an eye on is what? Probably the T-bill market at this point?
Yeah, it's the Treasury markets, the T-bill markets, and then sort of as we get closer to the date, of course, the equity markets will also be one to watch. It is, of course, interesting to sort of think about what if, and we are seeing various scenarios being played out in analyst notes, and we're also asking companies and CFOs about this. So far, I think what I've been hearing from interview partners in recent weeks has been very much what you described earlier, this sense that, yes, it's probably going to take some wrangling, but in the end, there will be a solution. But of course, this causes a lot of short-term pressure in the financial systems, and it causes companies to also think about potential scenarios. And so whilst there is an expectation that there will be a solution in the end, we will, of course, see sort of and how far this goes down to the wire, and if there's going to be any short-term financial hiccups because of that.
And Nina, all the while with still the option, I shouldn't use the word option because it's not proper in the scope of this, but with the potential of a recession at some point in the next few months as well.
Yeah, that's of course something that is also looming in the background. This recession, I think, is probably one of the most talked about and longest anticipated. So we do see, when you look at fund manager surveys and other surveys, then there is this expectations amongst money managers, amongst executives, also I think in parts of the population, that at some point there will be a recession. But then we're also seeing forecasts according to which the U.S. could just skip a recession. But of course, the more turmoil that this debt ceiling standoff is now causing, the more it could also feed into the wider economy, because it could lead to companies waiting, investments being delayed. So it's certainly a bit of a cocktail this year that we're seeing for financial markets and the economy, sort of the banking crisis, interest rates, the standoff, and also then this question around, well, do we enter a recession or not? So there's a lot going on right now.
Nina, pleasure to have you with us today. Thanks for your time.
Thanks for having me.